Alright guys, so I woke up this morning and looked in my Quora notifications and saw there was a question: what are the top 10 best investing tips? And me being the personal finance geek that I am, wanted to learn more and always check out other people's opinions. I thought, you know what, why don't I go and check this out and have a read of it? And then I thought, why don't I make a YouTube video about this? Let's see what people on Quora have to say and what their investing advice is, and let's evaluate it and discuss it together. So, let's get into the video.
Welcome to Millennials with Money. My name is Johnny. Thank you for joining me for this video. Let's get this money.
Okay guys, so as we go through this, we're going to try and keep an open mind. So be open to new ideas, stuff that we've not necessarily heard before. And we also need to have the ability to think critically about some of what's being said. So be able to assess whether there's an underlying bias, whether what's being said is reliable, if this person is a professional in finance or in the investing world and whatnot. So the first answer comes from K Jessica. If we scroll over her profile, we can't see too much about her, unfortunately. But anyways, let's have a read of what she says. So number 1 is to always have a plan. Number 2 is to stay disciplined. Number 3 is to diversify your portfolio. Number 4 is to review your portfolio regularly. Number 5, use dollar cost averaging. Number 6 is to avoid market timing. Number 7 is to consider your risk tolerance. Number 8 is to invest for the long term. Number 9 is to use a professional. And number 10 is to stay involved. And then at the end we have a little thing that says Quora FX, which is a registered company providing investing services to all of its members around the world. So we can perhaps assume that Jessica is somewhat affiliated with Quora FX. All right, so let's talk about this set of advice. So number 1, definitely agree. It's very important to have a plan. You know, it's pointless going into investing without knowing exactly what you want to achieve, what your strategy is, because if you don't have a plan, it's like, how do you know if you've been successful? How do you know what you're striving for? And how do you know what is a good investment and bad investment based upon your plan? Number 2, stay disciplined. Yes, absolutely agree. Once you've got the plan, you need to stick to the plan unless market conditions or your goals have significantly changed, then you need to stick to what your original plan is. Number 3, don't put all your eggs in one basket. Yes, I think this goes without saying, unless of course you're someone who has a philosophy like Warren Buffett and doesn't believe in diversification. Then for the majority of people, then yes, diversification is something that makes sense. Number 4, review your portfolio regularly. Now, for me, this very much depends on what is determined as regularly. As you will have seen in one of my previous videos, I deleted a load of investing apps because I believed that I was checking on my portfolio too often. And for me, too often was like every day, a couple of times a day, being able to open up my phone and check on the app. For me, that was too much because, you know, it can play with your head and you can start questioning your decisions and you can lose that discipline that she talks about in point number 2. Yes, I do believe it's important to review your portfolio regularly, but perhaps, you know, once a month, once every couple of months so often. You know, investing should be more or less on autopilot. In my view, you should be able to leave your investing on autopilot and then just check in every once in a while. You know, again, unless market conditions have significantly changed, then you should be able to leave your investing on autopilot. Number 5, use dollar cost averaging. Now, I don't do so many videos on individual stocks anymore, but on a video I did do last year, I talked a little bit about dollar cost averaging. And for me, dollar cost averaging, I think, is better when you're investing in ETFs, mutual funds, index funds, these kind of things. Because funds that track market indices generally trend upwards with the market, then in this case, for me, yeah, dollar cost averaging makes sense. However, if you're investing in individual stocks, then dollar cost averaging is less effective and you lose out on some of those capital gains that you can make by buying at undervalue. So undervalue is kind of the intrinsic value of the stock, and the economic value that it generates is still the same, but the stock price on the stock market at that point in time is below what the fair value of the company would be. Number 6, avoid market timing. We've all heard the saying, time in the market beats timing the market. And yes, I would agree. However, that's not to say that, you know, if the market's down, then you shouldn't adjust your strategy. You know, you could perhaps start even putting more money into the market when the market's down, because that's when a lot of the big gains can be made, when the market is trending downward. Number 7, consider your risk tolerance. So I made a video about this as well, and this is all to do with your investor profile. So yes, you need to be able to understand what you can and can't handle, what makes you feel uncomfortable, and what you can tolerate from a peace of mind perspective as an investor. Number 8, invest for the long term. Yes, again, agree with this. So investing for the long term, people who invest for long term typically come out with the biggest gains and the best returns on their investments. All right, folks, back after I forgot to delete stuff on my memory card and consequently ran out of space. So let's get back into it. Piece of advice number 9 is invest using a professional. Now for this one, for me, it very much depends. Professionals will be able to give you a very tailored, very personal investing plan and strategy, but they will of course charge commissions on your returns, or they might charge a flat fee for their services. So you do need to keep that in mind if you go with a professional. Yes, of course, a professional will generally, a trusted professional will know what they're doing with your money, and you can hopefully trust that your money is in safe hands. That said, there is a wide range of information available on the internet about investing, how stock markets work, what is in stock, what is an ETF, an index fund, etc. And you can educate yourself, and then at a certain point, you'll probably have enough knowledge to be able to manage your investments yourself. So it's really down to you. I would say, yes, there are pros of using a professional, but if you have the knowledge and if you know what you're doing, you can invest by yourself. And number 10, stay informed. So yes, it's good to know about what's going on in the markets, what's going on in the world, but take it with a pinch of salt. You know, the media are often quite sensationalist, and a lot of the investing and finance articles are quite over dramatized and focus more on the short-term movements of the stock market rather than looking at the longer-term impact. So you do need to keep that in mind as well when you're informing yourself. All right, let's move on to the next one. So we've got Hank Damish. On his profile simply says asset management, studied at the University of Alaska, lives in Alaska. So the best investing tip for me is stock market investing. Here are some of the simple tips to keep in mind when beginning in the stock market. Set your objectives. Setting long-term objectives can be of great benefit in stocks and shares. Level of risk, control over emotions. Study the stock market, diversification of investments, avoidance of leverage. Stacey Marie Filkins can help. Okay, let's stop right there. So already we're seeing some other name coming in, and if you read a bit further down the article, you can see horrific punctuation and just, yeah, constantly referencing this person. So we can stop and say that this advice is scam. I did actually read this while I was clearing up space on my memory card, and even though it's you know, generalist advice and it's a scam, I wanted to read it to you guys so that you know what to look out for on the internet when it comes to these people that scam you and want to take your money. So just watch out for stuff like this. All right, let's move on to the next piece of advice from investing. Stock investing for beginners. Learn to invest. Okay, so this looks like someone who is like myself, who wants to teach people about investing. So looking at their Quora profile, this person looks like someone who produces financial content. I don't know whether they're on Instagram or on Quora, but yeah. So let's have a look at what this person has to say. So number 1, set investing goals. Number 2, keep a long-term perspective. Number 3, get started as early as possible. Number 4, look around you for investment ideas. Number 5, invest early. Number 6, manage risks. Number 7, try not to time the market. Number 8, when you buy a stock, plan to hold it forever. Number 9, select fundamentally strong companies. And number 10, control your emotions. So a lot of similarities with the first opinion that we looked at. Let's have a look over some of the other points that this person added in. So number 3, get started as early as possible. Absolutely, absolutely love this one and agree with it completely. So the Money Guy Show, another personal finance YouTube channel that I watch, talks about the power of starting investing early. I'm going to put a chart on the screen now, and it shows you the power of compound interest and how valuable it is to start investing early. So depending on which age you start investing, these are the multiplying factors that kick in and how much your money can be worth in the future. So as you can see on the chart, the earlier you start, the more growth potential through compound interest your money has. So I really like that point about investing early. Look around you for investing ideas. Now he goes on to say here, look for products and services that you like and understand a bit about the companies behind them. And this is, I personally really like this one. It's something I did when I first started investing in individual stocks, because if you look around you for ideas, then you'll think, this is quite interesting. So how does this work in practice? And if it's something that you understand and that you're familiar with, then you're much more capable probably and more comfortable in determining whether this is something you would feel comfortable putting your money in or not. So really like this piece of advice, looking around you for investing ideas. Number 8, when you buy a stock, plan to hold it forever. So this comes from Warren Buffett. Now, if you look at Berkshire Hathaway's holdings, a lot of these companies Warren Buffett invested in 20, 30 years ago, perhaps even more, and he's consistently held onto those companies and they've generated him more value in the long term. So this kind of goes back to the long-term investing thing, which is where the longer you're in it for, you know, the longer term your investing horizon, then the greater potential returns that you have and the maximum potential value that you can gain from your investing. Number 9, so select fundamentally strong companies. Yes, this is good as well. Companies with good fundamentals tend to perform well and be good investments over the long term. So yeah, whoever put this one together, good work. I quite like some of the points you put in here, so it's a good job. All right, the next one we're going to look at is by a guy called Adam Fired. So if we go to his profile, he is the founder at adamfired.com. So let's have a look. What is adamfired.com? Okay, so he's an expat wealth management specialist. So very high expectations. I look forward to seeing what his advice is. So number 1, anybody can become a millionaire on a middle class income. You just need to follow the evidence, and then a picture of the Millionaire Next Door book. Number 2, real estate doesn't outperform, but it can work if you use leverage. Number 3, spending habits are key, not income. Number 4, estate planning is key for wealthier people. Number 5, negotiation is the easiest way to increase your income quickly. If you invest that income, it will indirectly be huge. Number 6, use cash. Most people spend less money if they need to physically give over an object. Number 7, be careful with DIY platforms, use them properly or not at all. Number 8, delay your gratification, compounding will take care of itself. Number 9, the 4% rule, how much you can draw in retirement. Number 10, read about human nature. It is the biggest reason for investment failure. All right, so this set of advice was quite different from the others. So let's go through it one by one. Number 1, anybody can become a millionaire on a middle class income. So yes, I believe this is true. If you watch the Dave Ramsey show, you'll have heard of the concept of everyday millionaires. And you often have people who call into the show who have, you know, regular everyday jobs, but actually have amassed a big net worth because they've been smart with their money. They've prioritized investing, they've spent their money wisely, and they've generally been good stewards, good managers of their money. So yes, completely agree with this one. And I haven't read The Millionaire Next Door yet, so I'm gonna add that to my reading list. Number 2, real estate doesn't outperform. Now, the diagram we have here is looking at real estate purchased with cash versus real estate purchased with leverage. So if we look at this diagram in detail, we've got $1,200 of rent. We see our gross annual income is $14,400, net expenses of $7,200, and net operating income of $7,200. The price of the property is $115,000. So if we were to purchase this in cash, we would pay $115,000. Okay, the net operating income, so that's NOI, is $7,200. There's no mortgage payment, so our cash flow is $7,200. So our cash on cash return that we have here is 6.3%, which is our $7,200 divided by the $115,000 that we put down. Now, if we were to finance this with a 20% down payment, our investor funds that we would use would be $23,000. So our net operating income would stay the same. However, we would have a mortgage payment of $5,436. Our cash flow would therefore be $1,764. However, though that is a lower cash flow, divided by the money we've put down, that gives us a 7.7% return on our income. Now, the example we've seen here is pure mathematics, and yes, based on pure mathematics, then it is more profitable to use leverage in real estate. And of course, if you get a fixed mortgage, then the value of your debt will go down over time, and that profitability in theory will increase because you'll be able to maintain or increase your rental income whilst maintaining the same kind of mortgage payment. However, getting into real estate investing is something that you need to think carefully about. You need to kind of come up with your strategy and think about what you want to do. And of course, I've mentioned before that Dave Ramsey, he's quite anti investing in real estate with leverage. He would always buy real estate with cash as an investing property, at least. So something to think about. We'll not go much more into that, but yeah. Spending habits are key, not income. Completely agree with this. So back to the everyday millionaires example, you know, people who make ordinary or average salaries, who spend their money wisely and save and invest what they have left, have ended up building, you know, millions of dollars of net worth. Whereas you've got sports stars and athletes and celebrities who sometimes make millions and millions of dollars from sports contracts, from team contracts, endorsement deals, and still end up broke because they just don't have the money management skills. So completely agree with point number 3. Number 4, estate planning is key for wealthy people. I'm not sure if I have enough knowledge to talk too much about this, but I would imagine, yes, that as your net worth and your assets increase, then you do want to make sure that should something happen to you, that they fall into good hands and that they're going to be properly handled should the worst come to the worst, God forbid, of course. Number 5, negotiation is the easiest way to increase your income quickly. And if you invest the difference, then it can make a huge difference. So yes, if you invest any additional income that you have, then of course it has the potential for growth. And as we saw before, the bigger the effect of compound interest can be over time. Number 6, use cash. People generally spend less money if they have to physically give over an object. Now, this is something that Dave Ramsey uses to justify not using credit cards. And if you're someone who perhaps struggles with discipline when it comes to spending, then this can be a good method, because if you have, let's say a £50 note or a £20 note in your hands, £50 note, it's been a while since I've been in the UK. I forgot that £50 notes aren't common. Let's say you use a £20 note to pay for something, then there's a psychological impact that you will feel from spending that physical cash. However, if you were to pay £20 on your card, then it wouldn't feel as painful because you can't see the money going out. Only when you look at your bank or card statement later will you feel that impact. Now, for me, that's not to say don't use credit or debit cards. If you're conscious of your budget, if you're conscious of what your spending decision will mean for you when using your card, then for me, then there's no problem with that. You just, of course, have to be aware of that you won't feel the psychological pain, and you have to kind of be extra mentally disciplined to be able to spend with a card. Be careful with DIY platforms. Use them wisely or not at all. Now, remember, this guy is an investing professional. So for you to go to professional is an underlying bias that he perhaps has when commenting this. But I agree that he does have a point, you know. But some of these apps, will not get into any names, do have nice and colorful designs, nice and colorful charts. They have notifications that pop up. And it can really turn investing into a fun game, when really investing shouldn't be a fun game. It should be something that's borderline boring, and it shouldn't be something that you need to constantly check in. So you do need to be aware of some of the risks that come with some of these online platforms that try and add color and brightness into investing, if we want to put it like that. So yeah, you do just have to be aware of how to use these platforms correctly and not get carried away with some of the exciting and enticing features that they have. Delay your gratification. Compounding will take care of itself. So again, we're coming back to compound interest. The longer you leave your money and let it work for you, the stronger that effect of compound interest. The longer you can refrain from touching that money, the better, because as soon as you take the money out, then the compound interest stops. Number 9, the 4% rule. Now, this is something that's talked a lot in financial independence and FIRE circles. So this is theoretically the amount of money you can withdraw from your net worth, from your assets, without kind of them depleting over the long term. Now, the person who came up with the 4% rule came up with it quite a while ago. I think it might have been a couple of decades ago. So I think the number may have even been revised, but the point is knowing how much of your investments you can draw out without them depleting and kind of impacting your FIRE or your financial independence over the long term. And number 10, read about human nature. It is the biggest reason for investing failure. Very, very interesting point here. Something that I definitely like to look into a lot more. Having studied kind of financial behavior and investing behavior during my master's program, I can definitely say that learning about some of the psychological elements of the human mind does explain a lot of investing behaviors. Definitely something I'd like to read more into. So I really like this contribution, quite different from some of the other contributions we've looked at, and definitely some interesting food for thought there. So good contribution, Adam Fired. And so if we look across some of the other contributions on the page, then we see a lot of common themes coming up. So investing as early as possible, managing your risk, diversifying, dollar cost averaging comes up quite a lot. We also see investing for the long term and having a plan come up as well. So those sites like Quora and Reddit wouldn't necessarily be my first port of call for investing advice and learning about investing. There are in fact some good tips on here. So this was really interesting to go through. Leave a comment and let me know, guys, did you find this video interesting and what did you think of some of the advice that we saw today? Now why not check out my other videos, and if you like this one and you want to see more content like this, then make sure you hit the subscribe button with the notification bell so you don't miss a single update. I'll see you on the next one, and let's get this money. Oh, the mic got in the way. I'll see you on the next one, and let's get this money.